Welcome to Daybreak Australia. I'm Haidi Stroud-Watts in Sydney. We're counting down to Asia's major market opens.
I'm Annabelle Droulers in Hong Kong, and the top stories this hour. Investors keeping their powder dry ahead of US inflation numbers, with some trading desks warning of big stock swings after Wednesday's CPI.
Janet Yellen admits China may retaliate against the Biden administration's planned tariff increases. We hear exclusively from the US Treasury Secretary.
And the Albanese government set to announce Australia's second straight budget surplus as it tries to ease cost of living pressures without stoking inflation.
Fairly cautious open given all of those threats looming when it comes to the start of trading this Tuesday session. We are seeing Sydney futures looking pretty muted at the moment, about 0.1% higher. We're following that wary session on Wall Street ahead of key inflation data from the US. Again, that's going to weigh on the outlook when it comes to what the Fed does and what some of these other central banks will do in turn as well. We are seeing these headwinds really building, not just from the inflation outlook and the data risk there, but also the risk of the threats on tariffs on China and potentially retaliation, as Janet Yellen flagged in our exclusive conversation. We'll get a bit more details on that, but certainly not a great deal of risk appetite as we head into this open. Kiwi stocks are already looking a little bit softer there in the early part of the morning session. Chicago Nikkei futures looking pretty flat at the moment. A50 China futures there also not making too much of a move. For Australia, we're of course looking to that second budget surplus there. Back in the black for the government for a second straight year. The fiscal standing is really near at the top of developed world counterparts. But of course, for Bell, when it comes to market expectations, it really is this kind of what can they do to address the cost of living crisis that won't stoke inflation, make the RBA jobs harder and push out even further expectations or hopes of rate cuts.
Yeah, that's right. It's really just that call perhaps coming through from a lot of the market. We were speaking with economists yesterday about that need for fiscal prudence from Australia as well. But here's the outlook we've got for Aussie or US futures that are coming online rather. And you're seeing again, it pretty much reflects what we had intraday, which was a very cautious and subdued session. So equities, bonds, the dollar really not moving too much because traders are just on that countdown to the US inflation print that's due Wednesday. The expectation that we'll see some sort of moderation, but still too high to warrant any sort of Fed rate cuts. So that's the state of play there. But let's also take a look at where we did see a lot of the action. And Heidi, I don't know if you're ready for this just yet. I don't know if anyone in the market is ready for this just yet. But possibly that return to meme stock mania. What happened, and I won't get into all the details here, but essentially we had the man or the person, Keith Gill. He drove that meme stock mania back in 2021 under the moniker Roaring Kitty. He made a return to social media. Is it FOMO? Is there YOLO? I don't know what's going on in the retail crowd, what the institutional side thinks as well. That's probably a different story, but that is the state of play there. Let's shift, though, to, as you said, Heidi, that exclusive interview we have with the Treasury Secretary, Janet Yellen. This is our top story today, saying that China could always retaliate against any steps the US takes to protect its critical new industries. Speaking, as I said, exclusively to Bloomberg, Yellen declined to confirm that the Biden administration is about to unveil new tariffs on Chinese goods, including electric vehicles, batteries and solar cells.
He believes it's unacceptable, as I do, to be completely dependent on China in these areas. And he wants to make sure, given that China is really not playing by the rules in the sense they have enormous subsidies in critical areas of advanced manufacturing, has resulted in overcapacity. He wants to make sure that the stimulus that's being provided through the Inflation Reduction Act to support these industries, and these are industries that are creating good manufacturing jobs in parts of the country that have been overlooked or have suffered from deindustrialization in the past. The president wants to make sure that he protects these investments. And I don't want to get ahead of the 301 review on tariffs, but this is a commitment that President Biden has made, and I agree with it. I was in China just a couple of weeks ago and made clear that we would not allow Chinese overcapacity to harm our emerging industries.
Does the U.S. want a trade war, though, with China?
We believe that we should have a deep and productive, and that we do in most areas, trade and investment relationship. We're working to stabilize our economic relationship. We do not wish to disengage from China economically, but we do think that the playing field should be fair. And China engages in unfair practices like massive subsidies of industries they've decided are critical. And those are cases where we will act to protect ourselves.
We've seen Beijing in the past, though, respond, and it's become tit for tat. Are you expecting a response? Could they go after Tesla or maybe American farm products?
Well, President Biden believes that anything we do should be targeted to our concerns and not broad-based. And hopefully we will not see a significant Chinese response, but that's always a possibility.
US Treasury Secretary Janet Yellen there speaking exclusively to Bloomberg. Let's get some analysis now with our next guest, Kerry Craig, who's a global market strategist at JP Morgan Asset Management. And it seems like we're here again. It feels like a flashback in so many ways in terms of both the meme stocks and also talking about the risk of a tit-for-tat trade war again. How much is the markets, or how much are you concerned about this really being amplified as we get into closer to the November election?
Good morning, Heidi. Well, it's certainly a risk out there when we think about the policy direction we see out of the US. I think for now, when we look at what's been announced and what can come through around EVs, there's still the realization that, when it comes to China, they do refine, I think, 90% of the world's critical minerals and inputs that go into batteries. So they're always going to have a place in terms of that production and supply chain for these things. And that it is quite strategic in terms of how they are being applied around certain industries or strategic priorities, which is a little bit more narrow than thinking about the impact of a broad-based tariff and a tariff war, which is what we saw last time, which would have much larger economic and inflationary consequences. For now, though, I think the markets are really preoccupied with the very short-term view on inflation and haven't even got to thinking about what the outcome of the November election might mean for markets. It's not something we really tend to get into until after August, once you have the conventions come through and maybe you get a little bit more clarity around the policy outlook. But for sure, international relations and tariff policy are something that can be determined through executive order in the White House. So regardless of the split between Congress, it is something that could be determined by the next president and therefore could have quite a meaningful impact when we think about the outlook for markets and for economies in 2025.
Kerry, Janet Yellen was speaking earlier about, China offering these significant subsidies to critical industries. And to be fair, we see that across a lot of major economies, right, including with the Inflation Reduction Act and including with the proposed Future Made in Australia policy measures as well. So is this a theme that you would be investing around in terms of we're expecting a boost to critical minerals in the Australian budget today? Where are you seeing the opportunities based around policy lines?
I think it comes back to that idea around this defragmentation of globalization that you've seen materialize over the last few years. It really is the idea that countries can't be as reliant on their trading partners for some of these critical resources. They need to think about how to diversify those supplies. And so that leads to, a greater focus on industrial policy, which was what the Inflation Reduction Act is and is what, effectively Made for Australia or Made in Australia is going to be. So it is a case of thinking about how that can benefit certain sectors and the focus of government spending to support that. So I think there's definitely an investment theme there, whether it's around renewable technology and greening of the economy, whether it's around some of these critical minerals that are going to be needed and their support. It will become a focus as an investment theme in terms of the markets. And I think also coming out of the budget, again, support for households, thinking about the cost of living pressures. There could be obviously knock-on effects of that in terms of thinking about some of the retailers out there and how they may benefit. So there will be implications from that, from the budget. Some of them more long-term, if we think about that industrial policy. Some of them potentially a bit more short-term, if we think about just a little bit more money in households and spenders' pockets over the course of the next year.
Kerry, which market in this part of the world is looking most attractive to you at the moment? Because we're seeing a lot of investors that are sort of shifting back into China. Are you in that camp, or are you still preferring other markets like Japan, for instance?
China's showing some signs of stabilisation. I think there's still a huge untapped potential there. It's really looking for a catalyst which is going to release all that pent-up household savings that could flow through to the consumer and really boost that domestic demand picture. One of the issues around why there is so much focus on subsidies in China is that the government is supporting these manufacturing bases to drive growth in the interim, and obviously can't rely on trade as a big get-a-jail-free card when it comes to thinking about the growth outlook. So China does show some promise. I mean, the valuations have crept up a little bit, but still very low by historical standard. And I think you will see tactical opportunities that come through there. But for now, we believe it's a little bit too early to become a bit more strategically positive on China until we see that catalyst, which would see that release of demand in the households in China. We prefer to think about other markets around the Asian region. Obviously, Japan is one that's continued to perform very well, and we see that continuing in both the economic sense as well as thinking about the market sense and the earnings growth that's coming there. And then a focus around what we're seeing in Korea and Taiwan, given that benefit of coming from the supply chains, the supply of chips and semiconductors, and the fact that global growth is looking a little bit better around the world, and that should be a positive for thinking about demand and exports from Asia to the rest of the world.
Yeah, so you're still thinking that the Fed is going to cut rates in September of this year, is that right? And if so, how do you see that sort of environment benefiting Asia? Because some people are saying Asia could be the region that really outperforms when the Fed does start to reduce.
Yeah, I mean, we're definitely looking at our forecast and thinking about the inflation outlook. We do see inflation coming down a little bit this week. That trend for inflation to head lower over the course of the year for us does mean the Fed can cut by 1, potentially 2 rates, and that would be starting in September. I mean, it's a bit of a baseline call given that inflation print this week, if it ticks up a little bit, would really see those expectations of rate cuts being priced largely out for this year rather than thinking about them being hiking rates. In that context, I think of that easy monetary policy, we should start to see that coming down in terms of the US dollar as well. That should be a bit of a boost for thinking about emerging markets and Asia performance. And again, if it's a case of that balance between growth still being good in the US, inflation coming off a little bit, that nominal growth story being quite good, that's still an area where you see corporates creating earnings and equities doing well. I think that would spill over effects into the rest of the region is what we're really looking for there in terms of the easing pressures around central banks in Asia having to hike rates if the rates in the Fed and US are going down and the dollar's going in the right direction, and also thinking about the demand that's being created from a US economy that's still expanding.
That was Kerry Craig, Global Market Strategist at JP Morgan Asset Management. Thanks so much for your insights. And still ahead, hear why CLSA thinks Tencent's total revenue grew at a slower pace in the first quarter. We'll have a preview of China's big tech earnings later in the hour. But first, Emmanuel Macron calls for a level playing field with China. Our exclusive interview with the French president is next. This is Bloomberg.
The Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizon Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Anglo American has rejected a second approach from BHP that values the miner at $43 billion. The takeover would have made BHP the world's largest copper producer. For more, let's bring in our metals and mining reporter, Paul Alan Hunt, who joins us out of Melbourne. So BHP increased the all-share bid by 15%. Still no deal. What's sort of the sticking point here, and what does the board want?
So the board last night, the Anglo board last night responded to BHP's offer of $43 billion by saying that it significantly undervalued the company and its future prospects. Specifically of concern to the Anglo board has been the structure of the deal. The structure would require Anglo American to spin off its Amplat's Platinum Group Metals business and its Kumba Iron Ore project. Management have spoken to shareholders within Anglo American, and they are under a lot of pressure to add value back to the company. Anglo American for some time has failed to keep up with its peers, including Glencore and BHP, Rio Tinto and the likes.
And Anglo, of course, is under a lot of pressure to explain how it's going to create more value than simply selling it to its rivals. So we do understand we're going to get more details on that then.
Yeah, so it was last year when Anglo American's board launched a formal review into its internal assets and its future strategy. Of course, a strategic review is usually the precursor to divestments or spin-offs themselves. However, Anglo shareholders have been largely left in the dark for ever since that strategic review was launched. Overnight, the company said it would suddenly release the results of that strategic review. So they've really been scrambling to present shareholders with an option of growth and promising that there's going to be value in the future. I mean, the copper business alone will be a significant asset as the world transitions. It's a key metal for the energy transition, and that's why BHP is so keen to get its hands on it. There are a few things that Anglo's board could do. The first is the polyhalite fertiliser project. I mean, that's a $9 billion project, and it is eating up a lot of money. So in terms of expenditure, that's an option to either slow down that project or find a joint venture partner for it as soon as possible. There are two other assets, of course. One is De Beers, the diamond business that has been struggling for quite some time, and the Amplatz business too. So we wait to see what the strategic review that is coming out later today actually says and whether it can add value to Anglo American's shareholders.
Yeah, certainly a lot of focus on those plans that Anglo will lay out. Well, that was our metals and mining reporter, Paul Alain. We'll have more with you in the next hour. But moving to the French president now, because he's used a trade summit in Versailles to unveil more than $16 billion in foreign investments from companies including Amazon, Microsoft and Morgan Stanley. Emmanuel Macron spoke exclusively to Bloomberg editor-in-chief John Micklethwaite, who began by asking him about Total Energy's recent threat to move its primary listing from France to the US.
I wait for any confirmation. I understood it was rumors, so...
But it's interesting that it's tied to the idea that he would face extra ESG measures here that he would not face in America, and he thinks that would affect his valuation.
Do you mean that we are more serious than the US in terms of green economy and transition?
Yes, but you also, in your speech at the Sorbonne, you said, as I'll paraphrase, you said you cannot let decarbonisation and growth be enemies, and this would appear to be an example.
And this is my point.
Yeah.
But the point is just, we have to be sure when we regulate, we should not over-regulate.
Yes.
And I think now we have to deliver. We need in Europe much more investment. We have to cut red tapes, have more flexibility. But in parallel, everybody has to be serious. I saw a lot of funds, a lot of asset managers saying, we are with you on climate change. Where is the beef? Are you sure you are sufficiently compliant? Are you sure you are clearly addressing the same issues? This is my point. And this is why we need the resynchronization between the US and Europe. The resynchronization is, number one, the US regulation in terms of climate change should be more serious and realigned than the European ones. Second, the Europeans have to invest much more and be more serious and realign themselves on the US.
If I look at all those people, or certainly Hermes, LVMH, Kering, all those ones, they have done spectacularly well by exporting to places like China. They've done very well out of globalization, and all the prescriptions you were just talking about in terms of Europe having higher trade walls, being tougher with China, you know what will happen in a couple of months' time? The Europeans will say, we want to put tariffs on electric vehicles, and what will happen is Mr. Xi, despite what he may have told you last week, he will come back and he will put tariffs on cognac, and that will help those very successful French business people.
Look, I think this is exactly the mistake we made 20 years ago on solar panels, and we killed our industry. I'm very simple. I don't lecture and blackmail anybody. I just look at the picture. When you have tariffs of 10 for Chinese electric vehicles entering into our market, and when you are taxed between 15 and 24 when you go to the Chinese market, you have an issue. And on all the different sectors, what we want is just reciprocity. We want, and in fact, more than that, more just than regarding the relation with China, level playing field. So what we ask for is exactly that. We want to be sure that in terms of tariffs, subsidies, rules of production, we have a fair competition. And I mentioned it very openly to President Xi. So it is not a geopolitical agenda. We don't want to blackmail and push back some of their production. We want to be sure it is fair. It's fair to launch precisely inquiries and look in details at the situation and revise it. If we are weak, if we are threatened by the fact that you can have retortion measures, you just don't do what you have to do. We had this discussion, and this is why they decided not to implement the first measures on cognac, but to withdraw the first one. So I think it's a normal approach, but look at the situation today. The European Union is the most open place of the world. But you cannot survive if at the same time you have subsidies and overcapacities in China and protection in some part of the market, and Inflation Reduction Act and Buy American Act in the US. It doesn't fly once again.
So Europe has got to get tougher now.
But this is a necessity, not because we are protectionists, but just because we want to protect our economy.
The Germans do not agree with you about a lot of this.
I think it depends whom in Germany and for which perspective. It's totally true that some German companies, when they are incorporated in China, for instance, benefiting from subsidies, not just German, European, American, their interest is probably to preserve that and to sell themselves their overcapacities in China to the rest of the world, and especially the European market. But the German economy's interest is totally aligned with the French economy's interests, meaning creating jobs, creating value, but just protecting your business and your people when they are attacked by unfair measures. And it's normal. It's part of the business. So for me, it's just a no-brainer.
That was the French President Emmanuel Macron speaking exclusively with Bloomberg editor-in-chief John Micklethwaite in Versailles. And you can get a roundup of the stories you need to know to get your day going in today's edition of Daybreak. Terminal subscribers go to Daybreak Go. It's also available on mobile in the Bloomberg Anywhere app. You can customize your settings so you only get news on the industries and the assets that you care about. This is Bloomberg. Some of the top stories that we're following this morning: in the US has ordered a Chinese crypto mining company off a property it bought near a Wyoming air base that houses nuclear missiles. The US Committee on Foreign Investment says the proximity of Mine One Partners' operation to a strategic missile base is a significant national security risk. The company must now sell the real estate it bought back in 2022. Senior South Korean and Chinese diplomats have held their first face-to-face talks in Beijing in around 6 years. Chinese Foreign Minister Wang Yi reportedly told his Korean counterpart, Cho Tae-yul, that both sides should oppose trade protectionism. A trilateral summit with Japan is expected later this month in Seoul. And coming up, we'll get the outlook on China's big tech as traders await the reports or earnings reports of Alibaba and Tencent.
The Australian government set to unveil its third budget later on Tuesday. One of the centrepieces will be spending around the future Made in Australia policy, which has similar interventionist ambitions to the US Inflation Reduction Act. Bloomberg's Paul Allen has more.
Australia's economic strength has been built on digging stuff up and shipping it out. It's an old idea which has paid off, and now another old idea is being revived, adding value to those raw materials first. This week in Canberra, billions in new spending will be thrown at green steel, critical minerals processing, solar panel manufacturing and other local industries.
So what a future Made in Australia is all about is not replacing private investment in the opportunities of the future, but attracting more of it That will require some public investment, and we need to make sure we get value for money for that.
A future made in Australia is a flagship policy of the Albanese government as it eyes an election campaign likely next year. In many ways, it was born out of competitive necessity. The US has the Inflation Reduction Act, Japan has the Green Transformation Act. Canada and France are giving billions in tax credits to companies developing clean energy. Direct government intervention is having a moment worldwide, and Australia doesn't want to be left behind. An early recipient of a $260 million loan has been Alpha HPA, which produces high-purity alumina, oxides, nitrates and sulfates, critical minerals key to the energy transition. Australia has abundant critical mineral deposits, but limited manufacturing, with the global supply chain dominated by China. Skeptics warn reducing that dominance will require more than nationalist policies and cheap loans.
I think it's critical for Australia to build a so-called alternative supply chains for critical minerals processing. But to replace or challenging China's dominance is impossible, because China's power is not just in the processing technologies, is the entire value chain, supply chains behind it.
With extreme sadness that I confirm Toyota will stop building cars in Australia.
It's worth remembering it was only a decade ago that government subsidies for car manufacturing in Australia were pulled, causing Ford, GM and Toyota to shut down local production. Subsidies and tax breaks are now back for future-facing industries, at least for as long as the political climate encourages it. Paul Allen, Bloomberg, Sydney.
And on budget, as we're waiting for the details of that, we are seeing pretty muted start to trading being flagged for Sydney stocks here. We're seeing futures down by just about 1/10%. A pretty cautious start more broadly across the region. Kiwi trading already a little bit on the back foot there. We have really seen kind of US equities ending Monday mixed, investors really staying on the sidelines a bit for what is going to be a data-fueled week, capped off by inflation, of course, and all the implications that print holds for the Fed and policy going forward. Nikkei futures looking a little bit more optimistic now. Singapore trading seeing upside of about 0.3% there. S&P futures looking very much flat at the moment. That caution also spreading a little bit more to FX as well, as we see the likelihood of yen intervention maybe a little bit less, a little bit more remote, Bell, going into that inflation report.
Yeah, inflation report, that's really the big market countdown, but also just the thick of earnings that we're in as well, particularly in this part of the world, given US ones pretty much in the rearview mirror for now. But Tencent and Alibaba both set to report their numbers on Tuesday. Tencent expected to post its slowest pace of revenue growth since 2022. Alibaba, on the other hand, may lag on profitability, especially in its e-commerce and cloud businesses. With us now is Eleanor Lung, head of Asia Telecom and Internet Research at CLSA. And Eleanor, it's the first time we've seen Tencent and Alibaba reporting on the same day in a number of years. What are you going to be watching most closely between the two of them?
That's right. Actually, it's the first time that they report on the same dates. We expect that Tencent's result is going to be quite solid. Top line growth is about 6%. Non-GAAP operating profit will likely be up around 16%. For Tencent, gaming business is the major concerning business segments last year's, because their top two game was in decline, and also they don't have a big blockbuster game last year's. We're still going to see the mobile game revenue growth is going to decline year on year in the first Q, because they're very aggressive in terms of monetizing their top game last year's. But however, we do expect the gaming business start rebounding in the second quarter, growing positively year on year, because they already changed the monetization team of their top game, Peacekeeper Elite, and they are going to introduce more innovative virtual item that is going to increase the monetization or revive the growth of the game. And for their second tier game, which revenue is over 4 billion and monthly active users is over 500 million, they accelerate the monetization of this game, and that including Wild Rift, Fight of the Golden Spatula, as well as the Crossfire, which we see this game are growing at over 30%. year-on-year. And they also have 20 approved games in the pipeline. An upcoming game is calling DNF Mobile, which has a very good feedback initially, and with over 20 million pre-registered users, we expect this game can contribute additional 5 to 10 billion RMB revenue for Tencent this year. Likewise, overseas, their Supercells also repositioned their game last year, leading to a revenue decline. But this year, they already done with the repositioning. So if you look at their Brawl Star, is up more than double year-on-year, and they also have a new game coming up. It's called the Squad Buster, which size is going to be comparable to the Brawl Star. On top of that, they're also going to have Nightingale, Assassin's Creed, as well as Delta Force to be launched in the overseas market this year. So we do expect their gaming business can regrow at around 8% this year, and non-game business can grow high teens to 20% because their ad revenue is going to be driven by video account, which traffic growth is still at over 50% year-on-year by growing users as well as time spent per users. Ad load is still low, 1 to 2%, and they haven't really done e-commerce ads there, and that will further boost their ad revenues. They also increase monetization of their payment, enterprise SaaS cloud, as well as their live stream e-commerce business. Although the top line growth is low, but their profit growth is going to be much higher compared to the revenue growth, because a lot of the revenue now they're recognizing in a net basis, and they are going to have a higher margin for this business. So we expect bottom line can sustain 15 to 20% growth this year. So 5% overall total yield plus 5 to 10% earning growth, and they're just trading at 14 times PE for Tencent.
Yeah, we've actually just been showing a graphic here, Eleanor, of the revenue breakdown. So continue. What else are you tracking from these numbers? Because you can see that, for instance, fintech business services is actually making up the largest proportion, and you were saying you're expecting that to grow.
Yeah, so for the gaming, it's growing 8%, but the gaming that we talk about is just app game. We haven't really talked about mini game, which is basically booming in China because the small game studio is struggling to compete because of the regulations and also because of the intensified competition in the market, because the government resumed the game approval, so there's an influx of new games. User acquisition costs for the game go up. So without any innovation, small game studio is difficult to compete, and they go to mini games to get revenues. But for the mini game, Tencent recognized on a net basis. So the revenue impact will be small, but the gross profit is basically 100% of the revenues. And that's why, although the top line growth is slower, on a full year basis, maybe 10, 12%, but the gross profit growth is going to be much higher, which is 15 to 20%, because I think these companies are now more looking for quality revenues, and that's why the profit growth will be much higher compared to the revenue growth. So we still can say that is a high growth company for these top names.
Eleanor, when it comes to AI, what are your expectations from both Tencent and Alibaba? Because it's obviously a pretty difficult struggle for competition and for access to chip technology for China in this space. But those two companies are seen as being the best kind of place to be able to come out in front amidst that competition.
Yeah, I think the China Internet Company has already acquired a lot of the NVIDIA high-performance chips right before the ban. So they all say that they have enough high-performance chip to train their model up to GPT 4.0 level at least. And once they're done with the 4.0 level, they will be able to dumb it down the model to smaller models and train that with the industry-specific data. And that will enable the customer to use the model in a more cost-effective way. The model inferencing is going to be a lot more efficient, and also they can use some of the low-performing chips for the model inferencing. They can even source the domestic alternative for the chip supply to support the model inferencing there. So I think China, in terms of AI application, generative AI application, I don't think that is going to lag compared to the US. But of course, the challenge is the future, that what if we want to upgrade the model from GPT 4.0 to even Sora or a more advanced model? We do need more advanced chips to support the evolution. solutions, and China need to come up with their own alternative solutions. I think the chip design they still be able to do, but in order to get the wafer like 7nm wafer, 5nm wafers, I think they still need to invest more to come up with their own solutions for China.
I wanted to get a last word on Alibaba. We're expecting to see a lag on profitability or the rise on sales. What are you looking for in these numbers?
Right. We think that e-commerce business is going to improve in the March quarter because they already adjust the business positioning. They focus on regrowing the user traffic on Taobao apps, and that helped them to increase the monetization. And also they are acquiring 5 million new merchants over the last 12 months. Most of them are white label merchant providing low price product to suit the new needs for the consumers. So we do expect that e-commerce may regrow at around 7% in terms of GMV, which is faster than the retail sales versus 0% last year's. So it's a lot better. Their take rate may be slightly declined because while their advertising is growing along with the traffic, their commission revenues come down a little bit, but they are planning to introduce a lot more advanced ad product in the next few months that will help them to improve the ad efficiency in the future. So hopefully in the future, GMV and CMR growth gap is going to be narrow. On the earnings side, you're right that we do expect that profit is going to be down year on year because of the reinvestments, such as the traffic and content reinvestment on their Taobao apps, as well as the aggressive global expansion, AliExpress, Taobao Deal, Cainiao, and also Sunart is still repositioning that position, closing down some stores that also increase the cost there. But I think towards the year, by December quarter, we probably will be able to see the e-commerce regrowing at 7-8%, their cloud return to double-digit growth, and profit is going to regrow possibly year on year. But in the meantime, they have a massive share buyback, $12 billion a year, which will be able to help them to support the share price while they are doing the restructuring of their business.
Right. All right, Eleanor, thanks so much for your insights there. That was the head of Asia Telecom and Internet Research at CLSA. And switching to another earnings story, SoftBank as well has laid out plans to get more aggressive in artificial intelligence after reporting a second quarter profit and a surge in the value of its assets, including chip designer ARM Holdings. For more, let's bring in our tech reporter Minjong Lee. And Minjong, it seems like Masayoshi Son aiming to go on the offensive once again.
Yes, they did reveal some positive results yesterday with some profit on the group side, which is positive as Masayoshi Son gets ready to do more investments on startups relating to AI and technologies relating to chips. However, we didn't see too much clarity on what kind of investments or companies or how much Masayoshi Son plans to spend on these new technologies. And we still saw the Vision Fund investment kind of continuously on this shrinking trend where they're kind of investing less and kind of busy still selling assets. So we need to wait and see a bit more for clues from SoftBank on what kind of investments they do have and plan down the road.
Minjong, what did we hear in terms of, the turnaround when it comes to the Vision Fund, right? Are we sort of through the period of divestments? It's been sort of a quiet shedding of assets that we've seen.
Correct. The company releases quarterly data on how much disposals of assets versus investments they've had, but for the past 8 quarters or so, it has mostly been a lot of disposals. Navneet, the CFO of Vision Fund, explained yesterday that the disposals is a natural course because they are already 7 years into the fund and it's time for them to dispose of some assets. Still, when we asked them about their plans on when they plan to pick up the pace of investments, we didn't really get a clear answer on when they really plan to become a little bit more aggressive on spending. So I think the odds are we do anticipate some more activity from SoftBank going forward, but the odds are likely that I think more action will likely come from the SoftBank Group side and less from the Vision Fund side. But we'll see. We'll see what happens.
Our technology reporter Min Jun Lee there with the latest on SoftBank. Still ahead, we'll be discussing the Biden administration's plan to hike tariffs on Chinese EVs. Hear why Bloomberg NEF thinks the move is largely symbolic. That's next. This is Bloomberg.
President Biden believes that anything we do should be targeted to our concerns and not broad-based. And hopefully we will not see a significant Chinese response, but that's always a possibility.
US Treasury Secretary Janet Yellen there exclusively speaking to Bloomberg about whether Beijing may retaliate against Washington's steps to safeguard investments in critical new industries. Yellen was speaking to us after we reported that Chinese EVs could face tariffs of more than 100% under measures the Biden administration may announce this week. Bloomberg NEF EV analyst Yi Mi joins us from Shanghai to talk about the implications. So Yi, let's start up with how much of an implication, how much impact you actually see in a potential tariff hike on the broader Chinese EV sector.
Thanks. I think this will just have more symbolic meanings because many of the Chinese EVs have already been locked out of the U.S. market. In fact, last year, we see that U.S. only imported less than 11,000 EVs from China. So Chinese EV were out of the U.S. market for two reasons. First, the current tariff at 27.5% is at a relatively high level compared to those in Europe, Australia, and other Southeast Asian market, where some of them even have a free trade agreement with China. And second, that is even some of the Chinese EV can make into the U.S. market. Because of the stringent requirement under IRA, they have to compete with locally made EVs on an unsubsidized level, meaning that they're going to undermine one of their core advantages on the price and affordability.
There's already debate as well, see, around how China could possibly get around any new tariffs, but could they look to tap Mexico or Southeast Asia, for instance, as a backdoor to the U.S.?
Yes, definitely. In fact, we already see some of the top Chinese EV makers like BYD are increasing their EV capacity in like Mexico, Thailand, or even Indonesia. But the primary purpose of those new investments is still to capture the local demand, where there's a rising demand driven by kind of the new policies as well as the new models. And they're also hinted at that they're going to use those overseas production bases as an export hub to North America as a market. But I think there's still wait and see how the election pans out and whether the U.S. administration will introduce new tariffs on those China-made EVs.
See, I wonder, when it comes to the overcapacity issue, what options are there for Chinese automakers, right? I guess they could start manufacturing offshore in the way the Japanese automakers did, but where do you see this, I guess, overcapacity issue concluding?
Yeah, I think the overcapacity issue will just prolong in the next 1 or 2 years, at least in China. They're also resort to various kind of competition strategies, like reducing their domestic prices to capture more demand. But also overseas market is where they see more growth opportunity. I think most of the Chinese automakers still looking for like Europe and many of the South Asian countries where they can absorb those the excessive demand. But for U.S., I think given the tariff and other kind of unfavorable policy environment, they still see it will be more of a market, but with potential, but in the long run.
So in this sort of environment of escalating or potentially escalating tariffs, then, what are the broader implications for the decarbonisation trajectory of road transport?
I think increased tariff as well as other form of trade barrier could be detrimental to both the local EV buyers, but also to those governments' climate targets. The reason is that in many of the major EV markets like Europe or the United States, a lack of affordable EVs is one of the reasons that the EV sales are stalling in 2024. And Chinese automakers have this wide portfolio of affordable EVs, and more importantly is that whether it's a Chinese brand, whether it's a Korean brand, they can really bring the competition into the local market and pressure the local incumbents to make better cars at an affordable price. So according to BNF's long-term EV outlook, we still see that the road transport sector is on a positive trajectory to reaching a zero-emission fleet by 2050, but a still slowdown in 2024 means that we'll have to speed up in the upcoming years. And if the governments don't really speed up the measures, they will likely miss the 2050 target.
That was our Bloomberg NEF EV analyst seeing me there in Shanghai. And as President Biden prepares that new wave of tariffs, a US trade group is pushing for higher levies on used Chinese cooking oil. Soybean crushers say a flood of used oil is weakening demand for US crop-based ingredients that are used in renewable diesel and sustainable aviation fuel. A group that represents the biggest US soybean processors wants levies to be higher than the current 15.5% rate. And we'll have more ahead on Daybreak Australia. This is Bloomberg.
We are seeing that the market has turned and it's gathering great momentum. And we are seeing basically the end to decades of deflation and economic stagflation.
That was the BlackRock head of Asia Pacific, Susan Chan, speaking exclusively to Bloomberg about Japan becoming an attractive destination for global investors. And that certainly has been, of course, really predicating or underpinning that big run-up we've seen in Japanese equities, that optimism we're seeing here. But this is the outlook ahead of Japan coming online here. Producer prices dated to note as well, pretty much coming in line with estimates.